Hello and welcome to Property Matters. I'm Stephen Galpin, and today we're going to be looking at the financial world surrounding property, and helping me do this is Lucy Waters, founder and MD of Aria Finance. Welcome, Lucy.
Hi, Stephen.
Nice to see you. Good
You
to have
too.
you in the studio. Lucy, I think the first thing let's talk about is the market sensitivity ahead of the November budget, because that's what's on everybody's lips at the moment. What are you anticipating?
Do you know, it's actually felt okay up until probably the last few weeks. I think there's always a bit of paralysis in the market when a budget is anticipated, and this one's quite late, so that doesn't do anybody any favours. I think the kind of speculation around big property tax reform, it's not so much that confidence isn't there in the market, it's more a case of people holding fire to see how that might impact them and their plans moving forward. So I think we've lost a little bit of liquidity of late.
Are you expecting a sort of fairly moderate budget in terms of the property industry? I mean, I'm thinking, for instance, they're talking about looking and reviewing the sort of stamp duty sector of the market. They're looking at perhaps introducing instead a annual property tax. Lots of different theories about what's going to happen. What do you think?
I think there will be something in terms of property taxes. I think there's been a lot of speculation, so I'd be really surprised if there was nothing at all. I suppose it just depends how aggressive that change is. I think a reform in stamp duty, obviously there's talk of putting it onto vendor side rather than buyer side, and actually I think for the mainstream mortgage market, I don't think that does any harm, because people, if it sort of feeds into property prices, which no doubt it will do, people can at least borrow against that, which will help first time buyers to be able to move, and then obviously the whole market moves up from there. So I think from a stamp duty reform perspective, that wouldn't be the end of the world, albeit there might be a period of reset where people who have paid a big stamp duty bill on the way in feel a bit loath to sell and pay it again on the way out.
That's easily solved though, because you can just say, look, if you've paid it going in and you've now got to pay it going out, then you can credit what you've paid going in against what you've got to pay out on your sale.
Yeah.
It'd be quite easy to handle. But I agree with you that I think it would help the market a lot, because it would then become a fundable item rather than something that you can't fund. And that will help our younger generation buy their first home, I think. Also, even if there is an annual property tax to replace stamp duty, at least that's payable annually, and you're able to spread that out over time. So it might just make the market a little bit easier. And I think one of the government's faults, irrespective of whatever colour government, they fail to look at the market as a whole. They tend to look at sectors and think, oh, we'll encourage that sector or we'll discourage that sector. And I think that's a mistake, because the market has to work from top to bottom, doesn't it?
Like anything, you're never going to please everybody. When you make these changes, there'll be winners and there'll be losers. And I think the annual property tax, there'll be a big group of people where that has quite a significant impact on, because people who have perhaps inherited property, they might be asset rich, cash poor, and that will seem like quite a big burden to them. And obviously there is also some talk that perhaps it gets rolled up as opposed to paid annually. Mansion tax is effectively what it is, whatever we call it, it's effectively a mansion tax, and I think that hasn't really worked anywhere. So I'm surprised that we're even talking about it, to be honest, because I don't feel like that will have a positive impact on the market at all.
I have to say I'm rather against governments tinkering with the market. It's a little bit like these help to buy schemes. I'm not sure that they're actually that helpful at the end of the day. It's all very well stimulating a market and encouraging new people into a market, but you've got to be sure that they can manage it. And if we're reducing the level of sort of stress testing, then you've got to be careful on the other side of not going too far, haven't you?
Yeah, and actually one of the big problems with help to buy is it created a lot of false value in certain segments of the market. So one thing that we've really noticed of late is lots of developer clients that we work with who have built big blocks of flats, they are really struggling to sell them, and that has been true since Help to Buy left the market, because there was this sort of false uplift where people had access to those units that perhaps they don't now.
Well, I think it's a fairly common thought in the market that the Help to Buy scheme helped developers rather more than it helps some of the
I think
people
so.
buying, and that's a shame. It's a shame because we do need to help young people buy property. I thought for some time that we might go down the sort of European path of people being less inclined to buy property, but that doesn't seem to be the case. People still have it as an absolute ambition, and it's a shame that they're having to wait perhaps well into their 30s before doing so.
I think home ownership's always going to form part of aspirations in the UK. It's quite deep rooted, isn't it?
Well, it's deep rooted, and it does breed stability, doesn't it? It breeds a stable family life, stable for the children, and a bit of safety all round. And I'm not sure that these high rents and things that we're seeing at the moment are that conducive to doing the same.
No, and that's the problem, isn't it? Because if we can't do what we need to do to stimulate home ownership for young people, the alternative is to rent. And with the sort of anti-landlord campaign that we've seen over the years, it's really challenging for landlords to thrive. And not to say that some don't, some absolutely do. However, I think the availability of stock, especially from your less professional landlords, we've been pushing them out the market slowly but surely, and with a lack of housing supply, the sort of pressure on rents has then made renting become, in many cases, quite unaffordable as well, which is why we're seeing more like co-living and HMO stock and things like that.
It's a very difficult balance to achieve, I think. I mean, one of the sad things is that we've been pushing the smaller landlords out who have actually provided quite a lot of rental homes for the market. We're pushing them out. The government would have us believe that it will improve standards doing that and putting all the rental with the big institutions. I'm not quite so sure, because if you look at the stats, mostly it's the housing associations and local authorities that are providing the substandard accommodation. So it's not the private landlord. And again, the smaller private landlord is often more caring and careful about his property and indeed his tenant than the big institution.
And actually, in many of those cases, those landlords are accidental landlords who perhaps, pre meeting their partners, they may have each had a house
Yeah,
and they
sure.
rent one out, or perhaps they're upsizing and decide to retain one. So I think that kind of feeling of wanting to look after the property is probably even more prevalent in that part of the market than anything. And I think there's always going to be a section of the market that drags the rest of it down, and I think that's true of most things. But my experience, and we deal with a lot of landlords, is that landlords on the whole, they really care, and they want to create nice homes for people. They want to have nice interactions with their tenants, and I think that is my general experience of the market. And it's a shame that the sort of more rogue end of the market is causing problems for those who really do care.
I think you're absolutely right. Lucy, let's move on now to another subject, which is very close to the hearts of those looking to buy property, and that's mortgage rates. A couple of things confuse me. I mean, when I bought my first home, your mortgage rate followed absolutely the bank rate. That doesn't seem to be the case these days. We've got bank rates on the way down and mortgage rates on the way up.
Yeah.
Perhaps you can help us with that one.
Do you know, if I had £1 for every person that calls me after a Bank of England review when the base rate goes down and says, does that mean, what we've been looking at will now be cheaper? And I have to explain why actually that's already been baked in to the market, because the expectation was that interest rates would fall. So I think the general public has learned a lot about swap rates in the last couple of years. And I would say most people who were not in the property or finance industry just wouldn't really have heard of swap rates. It's not a layman term that people need to know about. And generally, swap rates and base rate track fairly consistently. But what we've seen is in the rate volatility that has moved in a really unusual and peculiar way, and at points where we sort of saw sharp increases in interest rates, that was hard for people to understand, and especially where a base rate drop would come in but rates didn't follow, because actually we're kind of looking at a slightly longer term horizon, and we're looking at what the market predicts the interest rates are going to do. So unless you have a variable rate product where your mortgage is linked to the Bank of England base rate or similar, then it actually, there's it's not got nothing to do with it, but it's not what it's linked to. It's not, it's not a case of the rate drops and your rate drops. So base rate trackers, yes, Bank of England cut, your mortgage goes down. But if you're looking at taking a fixed rate, because there's a base rate cut, you can't then expect the next week to see the fixed rates have gone down, because probably they went down several weeks before in anticipation of the base rate cut, because of the data that's coming out about the economy and what the expectation is that base rate.
And of course, the next problem that we're going to hit is that I suppose the COVID period was the marker. We have a lot of people taking out fixed rate mortgages at that time to, I suppose, secure their position, or at least understand their position. But a lot of those deals are coming to an end now, aren't they?
Yeah.
And in the next year or so, we're going to see a lot of people wanting to renew and renegotiate their mortgage terms. Where are they going to go with that?
Well, we've seen it already, and I think there's a continuation for 2026 where we're going to see millions of borrowers come off of sub 2% interest rates. And depending on their situation, their loan to value, their income situation, their rates could double or more. And that is difficult because people tend to budget for what they've got at the time. And I think for most people that aren't sophisticated in how they borrow, that's really challenging, because they don't really know until they go and speak to their mortgage advisor where the interest rates are and what their payments are going to do. And that comes as a real payment shock to those people. And in some cases, especially, there's that sort of squeezed middle where they're not getting much government support, they're paying lots of taxes, but actually if they've got a family of 4, their disposable income's relatively low. So that payment shocks can be a lot. And I think I would urge people to speak to their advisors quite early to make sure that they know where that's going, not just at the point where that rate comes up.
Well, I think you raise a good point there about speaking to your advisor, because I think a lot of people will have taken these loans out with their lender directly, perhaps a building society or a bank, and they may feel a little bit pushed into taking whatever the bank offer them at this point of renewal. But I really do think, and I would advise anyway, that people see a broker, because it's such a complex market now, isn't it? They need that professional advice, and they probably could really benefit from the way that a broker will present their case or their application to a lender. Would you agree with that?
I definitely agree with that, and that's true on both the personal finance side but also on the investor finance. So you've got lots of landlords that have got big portfolios that have had really nice low fixed rates for some time, and with all the other changes and costs that are upon us for landlords and potential EPC changes, there is a lot that people need to have enough resource around them. So it's important that they know where their borrowing costs are going, and I think you just can't start talking to people early enough on that. Obviously rates can change if they're too early, things can change, but it's good to have an idea of where the market is now, and then they can start to plan.
But again, your broker or your advisor will keep you up to speed on that,
Exactly.
won't they? Yeah, I think that's good. I suppose I'm going to ask you to get your crystal ball out and say, well, where do you think the rates are going?
If I look back to January or the beginning of this year, there was a lot of speculation, and in fact, actually going back into the end of last year, there was a lot of speculation that we would see some fairly quick base rate reductions and a succession of them early on in the year. And that obviously didn't play out because we had stubborn inflation and various other things that meant that the Bank of England decided that it wasn't right to do that. It's really hard because what you think is true today can change very quickly, and I think we've seen that in our economy more recently, more than ever perhaps. And I fear that if you try and make predictions to where rates are going to go, especially if you're hinging your plans on it, we see a lot of that, a lot of landlords that say, I'm just going to hold off, I'm going to stay on the variable rate, I'm not going to do anything for now because I think rates are going to come down. And I remember having conversations with some of our big clients to that end, and it's hard because you have to, people will do what they want to do, but you have to be very careful that you don't end up actually costing yourself more because you're paying high variable rate or short-term debt, waiting for interest rates to fall, that actually the gain that you get when they do drop a little bit is marginal anyway.
Marginal and probably delayed.
And delayed, yeah.
Yeah.
I do think we're going to see them continue to tick down, but I would be surprised if they come down fast. I think we'll see another base rate reduction this year, I hope, and then next year I think it's anticipated that rates might start to tick down towards the 3% mark.
What is the norm now for a fixed rate?
For a residential owner-occupier, the rates are in the threes, and sort of mid to high threes, I would say. For the very standard residential mortgages, it gets more expensive when there's any specialist element to that. So whether it be complex income streams, multiple income streams that don't tick the bank's boxes from a employed 3 months pay slips type perspective.
Yes.
And then on the investor side, you're really seeing a range of product mix, because there's been a blend now where interest rates and fees, they used to be fairly consistent, that you would have interest rates and fees would all be kind of similar from lender to lender, but we've seen some high fees come into the market to allow lower rates so that investors can borrow more because of the rental coverage that's required.
No such
make
thing as
it
a free
work.
lunch, is
No
there?
such thing. It all works out the same. That's what I always say to people. Whichever way you cut it, it works out the same. But I would say interest rates in the buy-to-let mortgage market, most of them are sort of aimed at limited company, etc., and they're sort of in the low fives, and arrangement fees really can vary from sort of 1 to, in some cases,
Now,
7-10%.
what I'm also interested in, I'm sure our viewers are too, since the unfortunate episode of Grenfell, we've had the building regulations tightened up, and certain buildings have had to carry out remedial works to comply. Are the interest rates from lenders tied in any way to how they see the risk of a particular building? Because we've got two issues here. One, that the regulatory body who are now reissuing these certificates of safety have got such a backlog that they're holding up sales, and conveyancing times are taking longer and longer. And I just wonder if that makes lenders sort of a little bit nervous and think, oh, well, yes, we will lend on the property at the right point, but we're going to charge a little bit of a premium because we're worried about it taking time. We're worried about the standard of repairs perhaps, or the likelihood of sort of recertification coming up. What's the lender's position on that?
So for the occupiers of those buildings, people buying the units to live in, there isn't really any impact on the rate of borrowing and the lender availability. But what you do sometimes find is that the delays mean that they lose their rate, they lose their product, they have to get new valuations done, they have to go through the application process again, and it can be really unsettling for buyers when they're in that situation. And then on the other side of the coin, we deal with a lot of developers who have got these buildings and are just stuck, and they've got all the sales agreed and they can't actually complete the sales because they're waiting for BSR to go through the motions. And unfortunately, it's understaffed. It's a relatively new agency which just doesn't have the capacity and the resource to deal with things quick enough. So I would say that one of the biggest challenges has been on the developer side, where the holding costs, which can really make or break a transaction for people, those holding costs have been quite crippling in some cases and have actually made some schemes make little to no money at all. So that is a real challenge for house builders.
I've known for a long time that one of the biggest things that potential developers, even existing developers, underestimate, and it's that one thing called time. They forget that time is very expensive.
Holding costs.
Yeah.
It's the number one we see where people run into challenges, because we have to extend their facilities and you have to be so careful, and it's so important that you sort of stress test that, and that developers are stress testing that, because there's always something, whether it's regulatory, planning.
And again, it's become even more critical since the sort of advent of or the popularity of bridging loans,
Mm.
because you're on such a fixed time
Yeah.
that if you go outside of that time, it can get awfully expensive, can't it?
Yes, short-term lending is a fantastic product that has filled a massive void. So since really the financial crisis, we've seen the rise of bridging loans in, an exponential way, because it provides a really good solution. When liquidity was scarce in the market, there was bridging loans. It enabled people to transact, and I think it's just really snowballed from there, that it used to be seen as sort of a lending channel of last resort, whereas now most developer clients and property investors will have had some sort of experience with bridging at some point, and it's fixed term. It's 12 months usually. You can get longer, but most bridging loans are 12 months, and if you run over, you pay an extension fee. And the interest cost, whilst it's all relative because it enables them to transact and to make the most of these opportunities, it's expensive if you're on it for a long time. And we've seen a lot of customers get into trouble where they've been stuck on bridging loans for too long.
Previously, if you had a bridging loan, you had your bridging loan and that was the end of it. When you wanted longer term finance, you'd have to go elsewhere. That lending company for the bridge wouldn't transact to a long-term situation. But now they are tending to say, well, okay, stay with us and we'll perhaps put into place longer term finance. Are you finding that same thing with your lenders?
In the race to improve market share, a lot of lenders have diversified and have looked to other products to improve their business models, and we've seen many more bridging lenders enter into, say, the buy-to-let space or the development finance space. And for customers, that's a really good option, because if they have a bridging loan with a lender, it doesn't always mean that they're going to save money on fees, because normally they're seen as two very separate priced products, but it enables people to roll on to the next product with the bank having knowledge of them or the lender having knowledge of them. So it's familiarity and ease of transacting.
In real terms, it'd be an opportunity lost if they didn't, wouldn't it, really?
Yeah, absolutely.
Really. But I mean, I think, do you think this, what we've had over the last few years is a tendency for lenders to become specialist lenders, a buy-to-let lender, a commercial lender, etc. Do you encourage that sort of process, or do you prefer multi-operational lender who will keep his client for many, many years? Because it seems where you have specialist lenders, it's very hard then to create a long-term relationship, isn't it? Because you might be moving from sector to sector.
I think that's right. I think the specialist market is perhaps a little more transactional, albeit there are exceptions to that whereby long-term relationships are built and lenders will support clients in multiple projects across multiple products. So but I think generally there has been a bit of a migration to the specialist market, because actually a lot more falls into that category. And I think that that's great because it helps more borrowers. It gives people more access to capital and liquidity, and that keeps the market moving. So the specialist finance market is something that's we're very close to, and I've got a lot of time for, because it enables more people to borrow.
Well, again,
access to cash.
new opportunities are coming up all the time. Out of any kind of situation, opportunities exist. It's what you make of them, really, isn't it? And I know we've had a conversation earlier where you're saying one of our leading agents who does operate auctions, they've had record times this year because people are going to auction far more on private property, on residential property, than ever they were. And this is where bridging becomes particularly useful, doesn't it? You have the speed of getting that loan, and then time to sit down and think about what you bought and what you're going to do with it and how you're going to progress it through its life.
Savills auction at the beginning of October, I think raised something like 32 million. So for those who have got access to capital and access to debt, clearly those borrowers are still active. And I think the demand is actually still there. I'm confident the demand is there from people I'm speaking to. People want to transact. There's a little bit of a confidence thing, but a lot of it, I think, is just a case of waiting to see the outcome of the budget. So I think overall the market's not in bad shape, and for those who are prepared to still transact whilst all of this noise is going on, there's access to money and the market is moving quite well, and bridging loans, I think, forms a really big part of that.
I really don't envy your job very much. You've got such a complex market to deal with these days, haven't you? There's so many different facets to the market. You must have an incredible knowledge of the whole spectrum, really.
We have lots of different specialisms in the business, because I think nowadays each product deserves its own time and attention to make sure that people are getting the right advice, and it moves quickly. I think we've seen it settle a little bit more now. In 2023 especially, it was a really challenging time because we were all going through something which we hadn't seen before. Lenders were pulling their interest rates at the drop of a hat. Borrowers were losing those products very quickly, and that was quite a challenging time to try and help people navigate through. However, I suppose it's like anything, when you've been doing it a long time, it becomes second nature to an extent, doesn't it?
Well, usually you've seen it all before,
Yes.
in one form or another. But there we are. Lucy, just for the last minute of the show or so, let's take you past the budget. How do you see the market moving?
I'm optimistic. I think that the demand is there, as I just said. I do believe that people want to transact. I think people want to buy. I think that the sort of underlying demand for sure is there. I suppose the timing is a bit unfortunate, because we really then only have the first 2-3 weeks of December before seasonally we always see that shut down a bit anyway. So I do worry a bit that it will put the brakes on for the rest of this year to an extent. However, even if that is true and it doesn't pick back up after the budget, I think we'll probably see things start to really take off in January, because I think it's there to be done. I think there's value to be had. I think there's opportunities out there, and I think people can see that. It's just a case of making sure that they transact at the right time, which is why people are waiting.
Yes. Do you think this government will do enough to bring new people into the market?
I am not particularly positive about that from the way things have been going, if I'm honest. I think a lot more could be done.
Yes. And what would you do?
That's a really good question. I think they need to stop trying to tax their way out of it by picking on certain segments of the market, and without wanting to go too deep into politics, I think what we've seen towards landlords has been a real shame, and the thought that capital gains tax might apply to certain people selling their homes, that just doesn't sit right with me. So there's a few policies that I think will really halt the market, which actually probably don't bring that much benefit in terms of revenue to the government. So I would like to see them take a bit more of a holistic view rather than honing in on certain segments of the market.
Yes, I think you're right. As I think we said earlier, that for the market to work properly, it needs to work in every sector, from top to bottom. It needs to be encouraged and nurtured throughout the range of properties, throughout the range of people, areas, north, south. We need to encourage it all, and I'm not sure that anybody yet has come up with the right sort of policies.
Yeah.
But there we are. Lucy Waters, thank you so much for coming in today. I'm sure our viewers have found what you've said most intriguing, most helpful. Thank you for that. And of course, we're going to look forward to having you doing your roundup spot every month on property finance. So we look forward to seeing you next time you're in the studio.
Thanks for having me.
My pleasure. I'm Stephen Galpin. Thank you for joining me on Property Matters. See you again next time.